$397 billion. That is the amount of pure cash and short-term treasury bills sitting on the balance sheet of a single company right now. It's a staggering, mind-bending reality. But here is the truly unaddressed contradiction at the heart of this empire. While sitting on nearly $400 billion in liquid cash, this exact same company is simultaneously getting paid to borrow another $177 billion. Welcome back to Learning with Pratik. If you're new here, I try to increase neuroplasticity by exploring a new topic every day. I do all the reading and researching, so you don't have to. Today, we're deconstructing a true financial behemoth. In this explainer, Berkshire Hathaway. To really understand this trillion-dollar machine, we have to look past the folklore of its famous founder and look directly under the hood at its actual mechanics. So let's dive into it. To start off, we have to establish one fundamental truth. Berkshire is not a normal company. It's a conglomerate. Basically, a single-parent company acting as a permanent capital holding machine. They don't manufacture a single product at their headquarters in Omaha. Instead, they acquire mature, highly profitable businesses, and they acquire them with the intention of holding them forever. Unlike private equity firms that buy companies just to flip them a few years later, Berkshire is a permanent home for cash-generating businesses. Section 1. The magic of insurance slip. When you pay a premium for car insurance, the insurer collects your money up front today. But they might not pay out a claim for months, years, or maybe ever. This gap creates what's known as float. For Berkshire Hathaway, this float represents approximately $177 billion of other people's money. It acts as a massive, constantly replenishing loan. This gives Berkshire a tremendous structural advantage over almost every other corporation on Earth, because they get to invest this massive pool of capital for their own benefit way before any claims come due. And this is exactly where the model goes from just great to entirely unprecedented, -$9 billion. You see, normally borrowing $177 billion would cost a company billions in interest payments. But because of Berkshire's extreme underwriting discipline, meaning they carefully price the insurance risks they take on, they generated a roughly $9 billion underwriting gain in 2024. This means they were effectively paid $9 billion just to hold that $177 billion float. Their massive loan actually has a negative cost of capital. It is literally the closest thing to a legitimate money printing license in modern finance. Section 2. The 4 engines of value. The crucial point here is understanding the balance of this entire machine. We can methodically break down the 4 distinct business pillars that make up Berkshire's earnings. First, we have the insurance operations, that float generation engine we just discussed. Second, railroads and utilities, which provide steady, heavily regulated cash flow. Third, dozens of wholly owned operating businesses spanning across both consumer and industrial sectors. And finally, equities, their massive portfolio of publicly traded stocks. These 4 engines work in perfect harmony to constantly absorb and generate capital. Let's look at the heavy iron for a second, the wholly owned subsidiaries. We're talking about absolute giants like BNSF Railroad, Berkshire Hathaway Energy, Precision Castparts, GEICO, and beloved consumer brands like See's Candies. These specific, capital-hungry, heavily regulated businesses are deliberately chosen. A railroad or utility requires constant, massive infrastructure investment. They safely and predictably absorb enormous amounts of Berkshire's cash at very predictable, regulated returns. They're essentially the shock absorbers of the conglomerate. Beyond full ownership, Berkshire commands a $263 billion public stock portfolio. Their top equity holding is Apple, making up roughly 28% of the portfolio, or about $85 billion. What's deeply fascinating here is the philosophy behind this portfolio. They treat partial, minority ownership in public companies exactly the same as their wholly owned subsidiaries. Whether they're buying a railroad outright or buying 10% of a credit card company, it's all viewed through the exact same lens of long-term capital allocation. Section 3. The track record. The staggering mathematics of compounding over 60 years really reveal themselves right here. From 1965 to 2024, Berkshire delivered a compounded annual gain of 19.9%, compared to the S&P 500's 10.4%. Now, an edge of just under 10% annually might not sound inherently explosive until you compound it for 6 decades. That narrow edge translates into a 5.5 million% total return, meaning a single $1,000 investment in 1964 would have grown to roughly $55 million today. That is the difference between a comfortable retirement and absolute generational wealth. Context, however, is everything. Looking at performance nuance over time, Berkshire today is much less of a get-rich-quick vehicle and much more of a stay-rich fortress. Over 20 to 30-year horizons, it holds a modest compounding edge. During massive tech bull runs, the S&P 500 will actually often outperform Berkshire in the short term. But during brutal bear markets, Berkshire's cash pile and debt-free subsidiaries allow it to act as a defensive fortress, strictly limiting downside losses and allowing them to buy distressed assets at a steep discount. Section 4. Class A versus Class B shares. There's a massive divide between these two assets. The original Class A shares, trading at well over $700,000 each, were designed entirely as a high-price filter. The goal was to attract long-term partners, not short-term speculators. Class A shares carry one full voting right and can be converted into B shares at any time. Contrast this against the accessible Class B shares, trading around $490. Created in 1996 for retail investors, they hold only 1/10,000th of the voting right and are non-convertible. Yet, mathematically, they represent the exact same economic exposure to the underlying business. Section 5. The post-Buffett future. Enter Greg Abel, the new CEO writing his 2025 mandate. He recently stated, "Decisions are made faster, with better knowledge and greater conviction when they are made by those who are closest to the business. This will not change." This quote is a very direct signal to the market. Abel is emphasizing his absolute commitment to maintaining the extreme decentralized culture, the high-trust autonomy of subsidiary managers, and the ruthless integrity that originally built the firm. The institutional structure is specifically designed to outlive its founder. Yet there remains a highly valid bear case, and it revolves entirely around the $397 billion dilemma. On one hand, having nearly $400 billion in record dry powder is the ultimate defensive asset. It basically ensures the company can survive any macroeconomic shock. But on the other hand, it's a massive structural challenge. Deploying hundreds of billions of dollars at a scale that actually moves the needle and generates historical returns is incredibly difficult. Gravity takes hold. The math of compounding inevitably slows down as a company's sheer size approaches $1 trillion. Which brings us to the most critical, unanswered question for this financial fortress moving forward. Can Berkshire Hathaway maintain its compounding edge without Warren Buffett? Let me know your thoughts in the comments below, especially if you have something particular in mind. Thanks for watching. Tomorrow, we open a different page. Until then, Pratik